Welcome to another edition of Barside Chat. I'm Isaac Thompson alongside our CIO, Matt Jakimiak. And Matt, let's get right into it. Interest rates. A lot of pressure from the current administration and along with some new data on inflation and the labor market as well. So how are we thinking about it and the impacts to client portfolios?
Sure. Yeah. I mean, I think let's start by just saying that, I think the Fed is working and it's healthy, right? I mean, there's been a lot of smoke around what's going on, Trump and putting pressure on there, but I think it's still independent. Powell appears to be set with his term. He'll probably step out in May of 26. I don't see any change there. There's been some things around some individual Fed chairpersons and potentially relieving them of duty. I don't think that's going to happen. I think, if anything, what I'm more excited about, and again, I've kind of been in this business now way too long, is that this is, to me, seems to be one of the more healthy Fed organizations that I've seen in my career. Realize that we've had 2 dissenting votes in our last interest rate policy vote. That hasn't happened in 30 years. I mean, to me, that almost, just reeks of like group thought. Everybody agrees. We got to vote the same way. Like, to me, that doesn't make any sense. So like, it's great that we now actually have some differing opinions.
Yeah, absolutely. But what about the data, the inflation data, and more specifically, the labor market?
Yeah, and that's a great point. I think that's where this Fed is going to go, is they're really going to focus in on the data. And so specifically the data that they're going to look at, right? They've got 2 mandates. One is going to be labor and one's going to be inflation. Let's talk about inflation first. So inflation right now, what I would say is it's good and it's stable-ish. Like, I think we'll reserve judgment for future dates, but right now, CPI, which is the total inflation number, is right around 2%, kind of on the high side, high 2.4, 2.5, somewhere thereabouts. Core inflation's running a little hotter in the low 3%, but still within reasonable ranges, much lower than where it was just 18, 24 months ago. So it feels like inflation's okay. More importantly, and where the most recent data that came out is around labor. That is starting to soften. So we're seeing rising unemployment. It came out in August. The revisions to previous months were also weaker, and we're seeing increased jobless claims. So the Fed, and I think the market rightly is starting to look at this and say, okay, if inflation's stable, but now we're having what appears to be somewhat of a weakening labor market, that could ultimately conclude that we need to cut rates. Again, we can't predict that, but I think the market is saying they probably need to cut, and if we look at what the market's already done, they've already started to price it in. As again, the market's always kind of forward-looking. So if we look at the 10-year after the jobs report in August, we saw that the 10-year now has dropped about 25 basis points. So the market's already starting to price in cuts. And we're seeing that also in Fed fund futures. So I think we're probably on a path, I don't know when, but we're going to start to see some interest rate cuts between now and year end. So that's my thought. All right. So we've also started getting some questions from clients in terms of equities, and more specifically, the valuation on equities and where, what we think about it. U.S. equities in particular are hitting all-time highs. What's going on there? What are our thoughts?
Yeah, absolutely. And I think the big story here is that there's a lot of earnings growth priced in. And we tend to think about that in terms of a company's price relative to its underlying earnings. The higher the price relative to the earnings, the more growth is expected in those earnings. The earnings effectively are assumed to grow into that price. So the most simple metric is just price divided by earnings, the PE ratio. And that is, 10-ish on the low end, 25 times on the high end. We're at 30 times, and we've been there for a little while. And earnings can also be a little bit volatile, so sometimes we'll look at like a cyclically adjusted PE, a CAPE ratio, which is taking a 10-year average, adjusting for inflation, trying to smooth out and get a bigger picture. And by that measure, we're at 40 times in the U.S. So pretty rich valuations across both those metrics. The last one I'd point to is Warren Buffett's favorite indicator, which is total stock market cap divided by GDP, and that is at an all-time high, well above 200%. So by any of these cash flow related metrics, it's a pretty richly valued market. The tricky part, of course, being that markets can stay highly valued for a long time. Especially on the PE side, we've been hovering around 30 since 2017 or so. And the market's almost tripled in that time. So it's a lot of growth you wouldn't want to miss out on.
Yep, absolutely. And I think, clearly the U.S. is one component of our equity portfolio, but we do have a large exposure to international emerging markets as well as non-publicly traded U.S. and international exposure on the equity side. Talk about that and put that in the context of what you just said.
Yeah, absolutely. It's a great point. I think, first off, the international markets are a little bit more historically normal in terms of their price to equity ratios, kind of in that 17 to 18 range in developed economies and 15 in emerging markets. One thing we've done, and we've talked about it here, is that when we are allocating globally, we're looking at a long-term historical average rather than the most recent year, which can be a bit lumpy and can be more of chasing performance. So that has resulted in us being, slightly underweight U.S. and overweight international markets. And this has played out very well. Last year, the U.S. set an all-time high as far as global market cap. But then this year, international has far outperformed as that, ratio somewhat mean reverts. And then of course, to your other point about the private markets, in private markets, you tend to be able to buy more cash flow for your purchase price. And so we continue to see good opportunities there. And, tying back to interest rates, as long as they stay relatively high, although we'll see, credit continues to outperform. And I think, we've seen that in our Maslow income bridge strategy where our private credit managers are able to generate, what is a very attractive risk-adjusted return right now.
Love it. No, those are all great points. I love that you brought in Maslow income bridge. I think, maybe we'll conclude it here, but as always, we appreciate any feedback we get from our viewers. If you have questions, obviously send those to your service advisors. And if you want to talk any more about the questions that we have here or learn more about Maslow income bridge, let us know. We'd love to hop on a call and talk to you about it. Thanks again for Isaac and me. We look forward to talking next quarter.